Today, we're here with Lior from Wealth Research Group to talk more about what's been going on in the market. There's been a lot of turbulence, a lot of ups, a lot of downs, a lot of people worried about the overall market with interest rates, with the Fed, with inflation, and all these things going on around the world. Lots of macro, lots of worries about overvaluation of so many different stocks. Lior, where are we at right now? What are you thinking as a investor and looking for opportunities for your followers and your group?
I think we've had a substantial bubble bursting in the past year. If you look 1 year ago, you literally had a blog taking on Wall Street, taking on a hedge fund, changing the dynamics of the actual plumbings of the financial system. They had to stop trading stocks. And so that to me was like an Enron moment, like an event or a Lehman moment, right? An event that showcased a sign of the times. And the sign of the times back then, if you go and look at the participation of retail in the stock market, it was 28%. That's double where it normally is. So normally retail is about 14% of overall activity. It was amazing to see also that about a third of Americans put money either in AMC or GME. And so it was a different market. And since February 15th of 2021, if you plot any of these companies, hundreds and hundreds, even thousands of companies listed on the NASDAQ, on the Russell 2000, that are more predominantly overvalued, not just in the general, value investor, silly PE ratios that doesn't work for most of these companies, but all the other value criteria. You'll see that they've plummeted by between 30, 40, 60, 70, 80%. And so a lot of this fear that's now happening, it's the end of fear. It's the capitulation. But I think what happened is throughout this year, the retail plus ETFs, etc., they kept buying and buying in and buying in and buying in. And the problem with companies that don't have PE ratios is that it's hard for Wall Street to know exactly when to come in. And so the valuation for them can go down until it doesn't, until some hedge funds and some Wall Street money managers decide that the value is attractive enough. And since you just don't know when that happens, you kept seeing them going down, and you kept buying the dip, and it meant nothing. They kept going down and going down and going down. I think where we are right now is you've had the overall market join these sectors that were more vulnerable to inflation, more vulnerable to the potential of interest rate hikes. And now you're seeing Amazon down 25%, Tesla down 29%. You're seeing the generals, the big companies going down. And so if you're looking at this and just thinking to yourself, okay, well, I'm 37 right now, all of this, no matter where you track this throughout 2021, as long as you're buying good companies at sensible prices, you don't need to buy them at the bottom, at sensible prices. And as long as you understand that the first initial buy that you made into a company is attractive. In other words, you didn't overpay initially, or you were able to dollar cost your average and get to a cost basis which is attractive right now. As long as you've done this, you have nothing to worry about. This jargon, this term, long-term investor versus a short-term investor. But these are not the right terms to use. If you have 25, 30, 35 years left ahead of you to keep buying equities and just accumulate more of corporate America, you shouldn't even call yourself a long-term investor. All you're doing is buying more of the second economic engine of your life, the one that plays right alongside your career. Unless you have a business of your own where you stand to become independently wealthy, the second engine is very important. And with the second engine, at least my strategy is most of the time buy the leveraged ETFs that track the indices. Because if you look at it from a 30-year perspective, everything is a buying opportunity. If you're buying the indices, if you're buying either the S&P 500 XXX or the NASDAQ XXX. And the other hat that I try to wear is that of companies that are not market companies, okay? Because if you're looking at this other hat, companies that don't trade with the markets, that trade on their own merit. And the reason they trade on their own merit is that they're either not dominant in these indices, or they're not a cookie cutter stock for hedge fund managers. Those companies where you have the potential to make triple digits in a year or two or three, those should be the other side of your portfolio. The problem I see that I saw in the past year and a half is that people bought good ideas and not good investments. And that's where you get into situations where you're overpaying by a lot. Now, good ideas can become good investments if the price drops substantially. The problem is that once a stock falls by 50%, it needs to double for you to just regain back your capital. So you either track this company, keep seeing the performance, and keep lowering your average, and then your initial buy may have been premature, but overall you're building a nice position. But if you don't do that, if you're panicking out at the worst possible time after all of the sellers are out, then you're committing a sin. And so look, where we are right now is we're in a situation where the entire market has corrected substantially. The NASDAQ is having its worst month of January in history, worse than in 2009. And the S&P 500 is also in correction territory. I mean, these companies that are the biggest of the biggest, they have taken down the indices into a very oversold territory. And what I see coming next is trading in a range for a while. Because if you have Jamie Dimon saying that he thinks that there's 7 rate hikes coming, Goldman Sachs thinking that there's 4 rate hikes coming, some people thinking that there's 3 rate hikes coming, some people thinking that the Fed will do nothing, and the Fed themselves saying we'll do between 2 and 3. There's too much of a divergence in the market to create any meaningful direction. And that's why I think we'll trade in a range until the consensus is clear about what the Fed is doing. In other words, enough people in the market that manage a bulk of Wall Street money come to a realization that enough has been hinted and signaled and telegraphed by the Fed. So for me to make decisions, I can start buying stocks right now. The worst is behind me. I don't care if it's the actual bottom. It's enough is enough. I can start buying equities for my clients again. Or if the Fed just come right out and say it. I don't think that today, as we're doing this interview, we're in 2 hours, we'll know exactly what the Fed says. I don't think that today they'll say too much. I think in March we'll have more of an idea, but I think the June meeting is where you'll get all the clarity. First of all, in June, if they raise rates, they'll tell you exactly what they're going to do for the rest of the year, because they promised 3. If they raise in March and in June, that's 2 out of 3. You'll know more. Plus, you got the midterms at the second half of the year, so there's going to be a lot of political pressure to get these chip shortages out of the way. and all the other supply chain constraints. You won't have Omicron putting a lot of problems into the workforce, and I think you'll be behind a lot of these problems that the Fed can control, because they cannot control supply chain inflation. They can control demand inflation. They can raise rates and create a situation where it's less advantageous to borrow money or less advantageous to take out a mortgage. But they have nothing to do with the ports, with the truckers, with the teachers, with moms, single moms being home. They cannot get these people to change their mind. That's something the government can do by regulation and legislation or policy. So I think where we are right now is we've had a substantial move down. It may not be the bottom for some stocks, but it doesn't matter. Most of the sell-offs have been done, and it's time to get really aggressive, but understand that in the next few months, you'll be trading in a range, and it won't matter 2-3 years down the road. Just keep building your portfolio, keep building your wealth.
There's so many questions now. You have companies like Peloton, like you said, Peloton was a great idea, right? So you basically take a bike, you put an iPad on it, and you create this new world of home, workout. But now everyone has obviously kind of figured out that it isn't as big of a deal. You've seen an insane valuation. I mean, I think Peloton was over $150, and now it's just getting crushed. And you see it a lot of companies like this, a lot of companies that really have no actual future plan other than an idea. Like you said, it's basically you're buying an idea, and then if that idea doesn't work, well, then you're screwed, and that's what happens to the stock price. So how does it, as an investor, how do you avoid situations like that?
Well, I think the first thing is to actually look at financials and understand financials before anything else. A lot of companies have great ideas. It's not uncommon to stumble upon a phenomenal idea. It's about market penetration, and then to see if this idea actually works. Now, the thing about it is, a lot of these companies, if they come onto the market with a great idea and start getting traction, you have so much time before to make a decision. Literally, why rush? I see a lot of people rush in minutes to make decisions. You can take months looking at companies. Look, just think about companies that that have done phenomenal in the market. Companies that are up 10 times, 100 times even, and you had years to look at them and still make a lot of money. And so I think the first thing is hold off, take a lot of time to really understand the business, and then start looking at the financials. And if they all make sense, then give it time. Look at how this company is performing over time. Get more sense of what's going on. I call it building a watch list. If you go to our website, Patrick, to wealthresearchgroup.com, you'll see on the top menu a button that actually says watch list, and you can download all the companies that I'm tracking since April 2020. We first launched published in our free newsletter a watch list of companies. It was 29 companies in April 2020. They've all doubled or more since then. And the reason that we did that is because that watch list, I had that watch list for 3 years. So when March 2020 came, I knew exactly the type of prices I wanted to pay for these companies. And when we published that, it worked. And we published 6 or 7 watch lists since. So you can go and download those and look at them. I think that the bottom line message is that you don't have to make that decision today at all. There are, at any given point, so many great decisions that you can make easily instead of becoming a stock picker. The one thing I want to tell you is, when you look at the way that the average investor builds a portfolio, most of the problem, if you look at 30-year surveys and performances from mutual funds is not the companies people choose. It's the fact that they want to time in and out of events in the marketplace. They see Putin want to go into Russia, to the Ukraine, they sell a third of the portfolio. They see, excuse me, they see, you know, any event that we've had. I mean, I've been in the markets for since the age of 16. I've seen people talking about the pigs. You know what the pigs are?
Yeah.
The pigs were like 5 countries that are going to go. Portugal is going to go bankrupt. A country of 2,000 years is going to go bankrupt, along with Spain and Italy. Okay, we've seen a double-dip recession, a fiscal cliff, whatever. The end of the day, I think everyone on this interview, if you're listening to this, go to Amazon and buy the book Triumph of the Optimists. This is the best book about investments ever written, and it goes through excuse me, all the things that happened in the 20th century: World War I, World War II, influenzas, famines, capitulations of entire countries, droughts, the whole thing. And yet, if you kept buying stocks the whole way through, and you kept betting on America to continue with the success that it had and is having in terms of its corporate structures, you're going to make a lot of money over your lifetime. So, I mean, just understand that the mentality of the investor has to be that unless he is about to retire and needs that money, he has to keep buying more equities because he wants to own more of America, a bigger piece of America as he continues to grow older. And the rest of it, that is the 1%. The 99% is keep buying equities. Now, what equities do you want to buy? If you know a lot about, and you have the time to look at companies, and there is no doubt that in the last 2 years, the generation of people that have come onto the stock market are way more educated than the baby boomers ever were. The amount of content that's being produced on the public domain. I mean, just 5 years ago, if I wanted to search a ticker, I had to read like articles on Seeking Alpha or something. Now you get like, you search any ticker that you want, you get a gazillion videos on it. It's amazing. The amount of information and education out there is unbelievable. So I think this generation is going to be much more educated on finances, and I think that's a blessing. You have way more people that are going to become rich. This is going to be a very rich generation. The millennials and anyone just tuning into the markets, they'll make mistakes, no doubt. They'll get into bubbles. They'll do, but in the overall, the millennials are 33% of the workforce right now, and by 2030, they'll be 75% of the workforce. They're about to put trillions into the market, trillions, as they become wealthier. They build homes, they form their families, they take out lines of credit on their homes. I mean, they're about to get really, really rich. And we know that they're going to inherit a tremendous amount of wealth from their parents, the baby boomers, which are the richest generation in human history. So overall, the markets and the demographics in the United States look amazing. You have population growth, which you don't have in Europe, you don't have in Japan, you don't have in Russia. You have all the financial structure to innovate. You have more 30-year-olds than ever before in America right now. This is the innovation phase of your life, between 30 and 40. And your only competitor is a country that isn't really built for capitalism, with China or India. These are big nations. They're 5 times the size of the United States. So obviously they have big economies, and obviously they're part of the global economy. But in terms of creating wealth, America continues to be the motherlode. So just keep adding to your wealth by owning more and more of it. And as you grow more sophisticated, you'll find companies that are not market companies. In other words, they don't trade with the markets. Maybe they outperform some of the time, they underperform some of the time, but overall, they produce as much as the markets unless you buy them at opportune times. What you need to look for are other types of companies that are not market companies, companies that can grow substantially. Because if you just want the market companies, just buy the leverage ETFs and you'll do amazingly well over your lifetime. As long as you can take the volatility on the way, etc. I think the most important thing is to look at it like a boxer who takes on punches and keeps getting up, but differently from your physical body, which actually becomes tired from getting punches. Think about it like you have infinite energy to get up every time. This is how every dip should be viewed. You take a punch, you get up. Take a punch, you get up. And the more your career gets better and you have more disposable income, you need to put more into it. Over the course of a lifetime, there is no other way to build substantial wealth than in the stock market, and perhaps as a third engine with real estate. But I can go on and go on about this, Patrick. There are amazing articles out there about janitors that work for UPS or work for other blue chip companies and took their paychecks for 30 years and put them in their own companies because they saw, look, this is a great company. I'm going to buy more of the company that I work on. And they left with $6 or $7 or $8 million in their portfolios. There is this thing called the millionaire next door. It's real. You need to focus on your career so that the secondary engine can work to your advantage. And the last thing you should ever do is sell a piece of corporate America. Now, if you're buying companies, some companies, they don't do well. You need to get rid of them when they don't do well. But as a whole, as baskets of stocks, own as much as you can of America. It's the brightest thing to do.
So a lot of people are always confused on why it matters about the rate hikes. Can you give us just a really quick and simple explanation to why does it matter? Why do stocks go up and down based on rate hikes and what the Fed says?
So the Fed funds rate, which is what the Fed controls, is an overnight lending interest from the Fed to the commercial banks, JP Morgan, Wells, Bank of America, etc. When they have to pay more to the Fed to borrow money from it, they pass that cost onto their clients, and it would cost you more to take a small business loan, to originate a mortgage, or for big companies to issue debt, because now you're competing with higher levels of interest rate in the market. And so you can think of interest rates as gravity for stocks, okay? The more interest rates rise in a healthy economy, the multiples or the PE ratios for stocks should contract to a degree, because now to build real growth, you need to borrow money at higher rates. If your business creates a 20% return, but money costs you 10%, that's obviously going to impact your life if you can create the same sort of business with a 0% loan or a 1% loan. And so interest rates are really important to our way of life.
So really the best way to put it would be, it's just the higher the interest rates, the higher the cost of business for the loans, for getting capital for companies. So then that affects your bottom line, and that's going to affect the price of the stock, because we're always looking at forward earnings. So the forward earnings are going to basically cost more money to make the same amount of money that they're making in the previous quarters, because now they're paying higher interest rates, and that reflects in the stock price.
Yes, there's a secondary issue here where the big money, the sovereign wealth funds, and the money managers that are managing the pension funds of the firefighters, the teachers, the workers of big companies, they have mandates where they can only buy a certain amount of stocks or a certain amount of bonds. And when interest rates rise, they don't need to create the best returns. They need to keep their jobs. And keeping your job means taking on less risk. And taking on less risk means you buy more fixed income. So as interest rates rise, you don't have what's called TINA, TINA is an acronym for there is no alternative. In other words, right now, the S&P 500's dividend yield is higher than what the 10-year bond yields. And so a lot of money managers are saying, look, I can either lend money to the US government and get 1.6% for the next 10 years, or I can buy Amazon. I can get the growth, plus I can get the yield. And so a lot of big money managers almost use Amazon and Apple and Microsoft as hybrid bonds, not as companies, but as something that's even safer than a 10-year bond when those rates were so low. So as you're raising rates, the Fed funds rate is going to rise to, let's say, between 0.75 to 1%. That doesn't mean that all these government bonds are going to rise along with it, because the markets can see this ahead of time, and they've already raised interest rates on the 10-year bond and whatever else. That's why we call the Fed behind the curve, because they've done something that the market has already priced in. The problem is not that they're behind the curve. The problem is that they're trying to reach that curve too fast. That's what the market is afraid of, that this is not going to be gradual. And the other problem that the markets are afraid of is that once they reach the curve, are they going to go and be ahead of the curve, which means that they're going to tighten too much. Because interest rate hikes in the past 50 years, since we've gone off the gold standard, the Fed has done 6 interest rate hike periods, and they've all ended in a financial crisis every time. Twice in the 70s, one in the 90s, one in the early 2000s, another one in the 2000s, and then obviously the one that ended with December 2018 with the monetary Uturn, where literally Trump and Mnuchin were calling the heads of the banks to see if there was a real problem, or is this just the markets signaling to the Fed that they've raised too much. So because of this, the markets understand that they're going into a tough period. And that's why you're going to see a lot of investors starting to hedge. They're not going to buy these dips as profusely as before. This is not a zero rate environment anymore. You're going to see hedging. So you're going to see a lot of companies go to gold, for example. Gold is performing really well this year in 2022, and I think it's going to perform even better, especially once they really raise rates, because now you know that you're in a interest rate hike period, which ends in disaster. So there's less of an incentive to own stocks anyways. For funds, for you, it doesn't matter. You have 30 years. This is going to blow over. But for funds, yeah, they're going to start pivoting to alternatives. They're going to look at other ways of hedging the stock market. So that's why interest rates are really important. The Fed raises rates means that they're going to mismanage this process at some point. Okay? Now, what you're seeing in 2022 is amazing, because you're seeing the markets already telling the Fed that it's mismanaging it even before they started to raise. Even before they're starting to raise, Wall Street is basically telling the Fed, well, I know what you're thinking. You're thinking about 7 rate hikes. Do not do that. I know you're thinking about 6. Do not do that. No, not 5, not 4. 3, like you said, is fine. So, Wall Street fund managers don't call Powell and say, look, man, you're behind the curve, and they vote with their trading desks. So this is what you're seeing right now. You're seeing the markets and the algorithms basically pulling the trigger on the fact that Jerome Powell, what he did for a whole year before he was due for his renomination, said, look, inflation is transitory. I'm not going to raise rates, not going to raise rates on you, not going to raise rates on you. And the markets loved it. Obviously, he won his second term, which, like, that's such a bullshit thing to do, right? To get a jolly market so you can get renominated. But once he got renominated, the day after, he was like, you know what? I'm going to retire this word transitory. And now we need to, now that I'm confirmed, we need to talk about what's really going on. 7% inflation is just the CPI. The CPI doesn't have energy in food. It's actually like 11. So prepare for madness from us. And that pivot from him is what caused all of this. He lied for a whole year. Now he's telling the truth. The markets weren't ready for the truth, and now they are. So we're in a much better place in terms of the expectations. And I think what they're going to say in 90 minutes from now is they're going to say, look, we're not we're not pivoting again. There is a problem with interest rates. They need to be higher. The bigger problem is we need to start selling bonds because our balance sheet is $8.8 trillion, and it should literally be about $6 trillion. So we need to sell about $3 trillion worth of assets, and that's what the market is going to be really afraid of. And then they're going to need to calm people down with the pace. They're going to need to say that this is going to be moderate and gradual, and that they're not going to dump everything, which I'm sure they will, because obviously they're under a lot of pressure to calm people down. But what you also need to see for the markets to really become excited is, one, other companies like Microsoft that are able to tell you, hey, we beat on the top line and bottom line. In other words, we were able to navigate this inflation environment, the supply chain constraints, these labor shortages. So can you, because the markets now say, okay, if Microsoft can do it, then other companies can do it. That's good. That's what happened yesterday. That's why the markets are up today, because the second largest company in the world was able to do it. Then it's going to exemplify to other CEOs that it can be done. And secondly, you need to see Biden panic. You can't see him waking up at 10 a.m. and reading teleprompters. It just doesn't work. I'm not being political. I'm saying what the markets want is for Biden to panic. They want to see that this guy wants to really solve the chip shortages, that he wants to really solve the port closures, that he's trying to close deals with other countries so that we don't have problems. And we're not seeing that. We need to see him panic. There's a very good market adage that says markets bottom when policymakers panic, and that's so true. We need to see the administration saying there's a real problem and we need to solve it. And we're just not seeing that yet. So that's why I'm saying I think we'll trade more in the range until they really fear that they're going to lose the midterms and they're going to start, legislating things to get things done on the chips front, which is really important because of obviously most Americans buy cars.
Yeah.
And auto loans is a huge deal in America. So I think that's really important. Overall, the fundamental economy, real estate continues to be, if you're asking me like, leave the stock market alone for a minute. What is the best thing anyone can do right now to build wealth immediately? I would say get into real estate in whatever capacity you can. Part-time, a side hustle, doesn't matter. There is a 2 to 3 million home shortage in America right now. And this is before these millennials really start to understand that they can work hybrid, which is happening. The work hybrid is happening. So you're going to see a lot of people move to the tax arbitrage states, right? Like Texas, where you don't have any state taxes. You're going to see a lot of movement. The real estate market, even though it's extremely expensive right now, it's going to have a nice, correction, and it's going to become more sensible. But it doesn't matter for the fundamentals. There are 2 million homes that are still missing. So if you can get into being a realtor, or if you can find land banks, or if you can find a mentor and work for free and just do some sweat equity for him, like I used to do when I was 24 and broke. I went, this is 2008. I literally started to get into real estate. I told this cash buyers, where do you need homes? Let me go find these homes for you, because they were doing deals. They were doing rehabs and stuff. I was finding them the deals. Whatever you can do in real estate, this is the one industry where you don't need a degree. You don't need anything. You need a mouth to go into these investing clubs in your own town, to see what people want to buy, where they want to buy it, and to go do some work and understand where you can bring value. And I think that's 76% of America's millionaires are from real estate. It's a fact, including your last president, right? So, I mean, that's where the mother lode is. If you're looking for, I don't know if you've seen that, Patrick, there was a show called Undercover Billionaire.
Yeah.
They drop him off. So this guy, I think, was in the insurance business. Billionaire, goes into this small town in Michigan, a 10,000 people town. He's trying to find like tires for the first show. He's trying to find a tire. He goes on Craigslist, sees what people want to buy, and goes and look for like a secondhand tire that was thrown to some landfill and trying to sell it. He makes $500, and then he says, okay, well, now I need to flip a home. I need to put a down payment on a home for $500 and flip it. And that's how he made $30,000, and then he bought a restaurant. It's a phenomenal case study of how he does that. He goes from zero to a $900,000 restaurant in like 4 months. But this is how you do it. You need to understand that there's a lot of opportunity in real estate, no matter where you are and what your background is. This is the most accessible industry to every American.
We're gonna have to get you back here after the Fed talks today. Maybe next week or so we can get you back here to talk about kind of what you think they talked about and all that fun stuff, and we can talk more about kind of the future and what you think with gold and silver and some of the other topics that I know you're an expert in. So definitely looking to have you back here very soon, and I'm sure our viewers are going to be excited to hear more. So again, thank you for everything, and looking forward to finding out what exactly happens today with the Fed. It looks like the market's, up 1.7 right now, the SPY. So it looks like everyone's anticipating a good Fed meeting or a good announcements.
Well, they're happy about Microsoft. It was a big deal for a company like that to say, look, we've been able to chew through the wall and beat on top line and on the bottom line, and we're able to continue with our business despite everything. So I think that's really important. By the way, Patrick, we created a special report for your viewers about our 2022 outlook, like everything I just said, but in a PDF form where you could just sit down with and read it at your own pace. If you go to wealthresearchgroup.com/2022 or 2022, where people can download that. That's pretty cool because it goes through the entire thesis for the year and why we thought that this first half is going to be very problematic, and basically all the gains and all of the fun stuff is coming at the back half of the year. Awesome.
Thank you. I'll definitely put a link down below, and everyone will be looking forward to seeing that. So again, thank you for your time. I know you got lots of things to do, but we'll have you back on here real soon to talk more.